We're going to do part 2 now of our taxes and required minimum distribution series, where we talk about how RMDs, required minimum distributions, can really put you up against it when it comes to taxation that you have to contend with. So let's go right into this. Again, I'm using Mr. Pistolka's website here at pistolka.com. Highly recommend you look at that if you're interested in all the Excel spreadsheets. Just scroll down here to the required minimum distribution table he created, and let's go ahead and show it to you. So basically, this is this right here. And if you didn't see my other video, just click right there. I just did it a few minutes ago, so I'm wearing the same shirt. But the RMD video on how RMDs work to begin with, and the taxes that come with it. So, how RMDs, the amount of RMDs that you got to be contended with. In a brief, we'll just say, remember, we have Bob and Jane. Jane's working. She's 55 years old today. She has $400,000 in her account, and she's not going to contribute to it anymore. She's just going to let it sit there and grow at 6% a year until she hits 70 years old, in which case she'll be forced to start taking distributions out. And if she gets 6% of the year over the next 15 years, well, she should have $958,000 in that account, in which case she will be required to start taking mandatory distributions. So we can just look at Mr. Pistolka's table here, and he did all the grunt work for us. He said at the end of the day, we take the factor of 27.4, divide that into the previous account year's balance, and that gives us an RMD amount of $34,963. All right, so again, the factor is RMD factor is when we take that, divide that into the previous year balance, the previous year, not this year's, but the previous year's end of year balance, and that gives us our RMD. All right, so an RMD of $34,963. We're just going to cut and paste that. We're going to come over to my somewhat infantile spreadsheet compared to what Mr. Pistolka does. I tried to do I got a decent enough spreadsheet here, but not anything like what that guy does. It's amazing, actually. So we're going to copy that into, we got to get rid of that negative sign. So this is our married sheet, and this is for single, but Bob and Jane are both with us. So we're going to copy that RMD amount into this section. We'll talk about this one here shortly. And what we do is we figure, again, they have $42,000 of Social Security between them. We're going to say that one has $28,800, 42,000 minus, I'm looking at my calculator here, guys, 8,000. So one has 28,800, the other has 13,200. So 28,800 and 13,200 gives them $42,000. We won't get into how they got that. It doesn't matter. At this stage, just bear with me. That's what they have for Social Security. But you do need to know who has what, and we'll talk about that here in just a second. So $42,000 between them. We take half that amount. We add that to their other income. In this case, their only other income is the required distributions on Jane's IRA. And we take these two numbers, and this gives us provisional income of $55,964. So we use its Social Security tax tables, which means of that $42,000 of Social Security, based on a provisional income of $55,964, there's $16,000 of their Social Security will be subject to income taxation. All right, so $16,000 will be subject to income taxation. So we take $16,169, again, bust out my trusty calculator, 169, add it to their other income, $34,964, and that gives us a total taxable income of $51,133. $51,133. Come down here, and we get $24,000 as a standard deduction, and we have taxable income total of $27,132. $27,132. So we cut and paste that. We go to my taxable income calculator here. We put that in. We got to go over to married because these are married, filed jointly. Yep, that's a single. So we come over to my trusty old calculator here. We put taxable income of 51, or we got to actually, no, let's hold on. We're messing up. We 27,132. That's right, 27,132, excuse me. So we put 27,132 here. It doesn't let me do that. So 27,132. And we get a tax amount of $2,874. So I'm going to write that down, $2,874. All right, so we have $174 of taxes on all this amount of income right here. $42,000 plus $35,000. They paid basically less than $3,000 on $77,000 odd dollars of income. Not too shabby. But it gets worse because that's the first year of their RMD. So now we go to, let's just say year, 83. We'll use year 83 when that's the time where it's the maximum amount that Jane's IRA grew to before the required distributions were bigger than the amount that she was getting. So remember, she's expecting to get 6% rate of return. Her RMDs are less than 6% up until this point. And then finally at this year, her RMDs start getting larger than the amount that she is getting from a growth. So now it's like a bell curve. Now she's at the very top and it's going to start going down because her RMDs are larger than the growth she's getting. So at age 83, she has an RMD of 66,837. We take that amount, we come back here, we put RMD of 63,837. We say to the computer that we're okay with adjusting that screen there, and we get that minus sign out. All right, so now we have total income of over $100,000, about $109,000 of total income. All right, I'm just writing that down to keep notes, of which their provisional income is $87,838. Now, what that means is we have a provisional income of, when you factor in the Social Security ratings, and how they do the factoring, I should say, of $43,000. So that says their taxable Social Security income is more than their total Social Security benefit, and that doesn't make any sense. So what happens is you can only pay a max of, you only have 85% max of your total benefit will be subject to taxation. So 42,000 times 0.85 means 35,700 is the max that will be subject to taxation. So we take 35,700, we add it to 66,838, which gives us 35,700 plus 66,838, which gives us total of, I'm just going to write over here, 102,538. That's their total taxable income, 102,538. We subtract 24,000 from standard deductions because they have two standard deductions, and we say that will be their taxable income will be 78,538. 78,538 will be their taxable income. 78,538. We're going to come over here and we're going to type in 78,538, and that means their taxes are 9,174 now. 9,157, excuse me, now. So their taxes bracket, their taxable income has gone up, not quite 3, but about 2.5%. But their income has gone up about 2.5% as well. Not 2.5, but their income has gone up as well. All right. So because their RMDs have gone up, their taxes have gone up. Now, still $9,100 of taxes on a total income of about 108, about 142,000. Total income 42,000 plus 66, 108. So they're paying 9,000 on 180 income. That's about 8.5% effective tax rate. Still not too shabby. I mean, they get $109,000 of total income, and they're paying 8.3% as an effective tax rate. That's not too bad. So even though it's higher by almost 2.5% times what it was before, it's still pretty favorable. But watch this. Now is when it gets bad. It is going to get worse too. I mean, don't get me wrong. Look, I mean, here you're showing the RMD tables is right here. So the amount of RMD is going up and up and up and up and up. So now we're going to have Bob die off because we always have the woman surviving the husband just because it's the way nature is. And so now we have a $90,000 RMD for Miss Jane. 90,004 is our RMD because we take last year's balance, divide it by this factor here, 12, and that gives us 90,004, which 1 divided by 12, which is, another 8.5% distribution rate, actually 8.33 to be exact. So she has to take 8.33% out of her portfolio to satisfy Uncle Sam, which is pretty significant amount of money. In fact, here it's $90,000. If I just may, remember, we're only going at 6% a year. It's not like we're swinging for the fences and trying to get grand slams. 6% a year, probably a 60 to 65%, 35 to 30% bond stock to bond mix. It's a moderately aggressive, but it's not swinging for the fences here. It's just trying to hit doubles. And so $90,000. And remember, she only started with $400,000 when she was 55 years old. So watch this. But now we go to the single tax category. And this is where it depends what Social Security matters. Who is getting what? So we're going to say Jane was making the more Social Security. We're going to say she was making $2,400 a month, and Bob was getting the $13,000 something. So we're going to lose Bob's account, and we're going to retain Jane. So Jane no longer has Bob's Social Security, but she does keep her own. But she still has her same required distributions. The RMD amount does not change because Bob is dead. The RMD's amount stay the same because it's based on her age, and that hasn't changed. That is still the exact same thing based on her age. So her RMD has just gone substantially higher than what it was, but even though Social Security has changed, the RMD has not. So now we take in $28,000 divided by 2 to get half of Social Security plus her other income. Her total provisional income is $104,404, which is significantly higher than the Social Security amount she has. Again, you can only pay 85% of your total amount is subject to taxation, which means $24,480 would be subject to income tax. So we take the $24,480, we add it to this right here, which gives us this amount right here. $114,484 is her total adjusted gross income. We subtract that by $12,000 because she does have one standard deduction, minus $12,000, and that gives us an amount of 102. Taxable income is 102,484. Now, she only has one standard deduction, which means $12,000 is more subject to income tax because Bob is dead. So not only does she have significant RMDs, but she lost significant, almost $13,000, $14,000 of Social Security, but she also has another $12,000 of taxable income because Bob no longer is alive, thus his standard deduction is gone. So now her taxable income is 102,484. Let's go to my trusty old tax calculator here. And again, this is going to be for single taxpayers. All right. And we already have it there. And so 102,484, which I'll show you, puts her deep in the 24% tax rate at $18,894. So $18,894 on total income of $90,000 plus $28,800, total income of $118,000. So basically, she is in a 10% effective tax rate now. 10% effective tax bracket or tax rate. Again, that's not bad, but it's a heck of a lot more than it was before when she and Bob were both alive. Her effective tax rates were much lower than that. And her amount of taxes has gone from under $3,000 to $9,000 to now almost $20,000 because her income has gone up because she lost the standard deduction, even though she lost the Social Security by her RMDs. Now, one thing I want to point out to you, don't forget she has total income of $118,000. That is going to be considered her adjusted gross income. Her adjusted gross income, again, is before Social Security kicks in, or standard deductions kick in. And your standard deduction is $12,000. So her total income is $118,000. Let's look at the medical charts, the Medicare charts. So the Medicare charts show a single couple, a single taxpayer with modified adjusted gross income above $107,000 has a premium of $133 on top of the standard premium. So her standard premium for Medicare Part B is $134. Just basically is a double because $133.90. So basically her premiums on Medicare Part B have gone up by 100%. Her prescription Part D has gone up by $33, not quite a doubling, but pretty doggone close. So because those RMDs are where they at, she has now another $170 a month reduced from Medicare Part B and Medicare Part D. She's in a higher tax bracket on top of that because she's a single taxpayer. She lost a standard deduction and she lost Social Security. So she loses an income source. She pays more taxes because she loses a standard deduction. She's in a higher tax bracket, and she pays twice in Medicare Part B and D than what she was paying before. That's the issue when it comes to taxes and required minimum distributions. Remember, folks, we only had Jane starting off with $400,000 when she was 55. We didn't have her adding anything to it. We didn't have her with exceptional rates of return. We just had her with $400,000 at 55 without even adding a penny, without any kind of great rate of return of 6%, which isn't bad. I'll take it. But we're not asking for incredible numbers here to exemplify the point. The point can be shown easily just in real world numbers. 6% rate of return, RMDs on a single widow or widower will affect your Medicare premiums, Part B and Part D, and on top of your taxes as well. And that's, let's see if I can't just get it to go up here. So I love the Chromebooks, but sometimes they're a pain. This, I'll link the show notes, what this right here shows you from socialsecurity.gov, Medicare premiums rules for higher income beneficiaries. And as the RMD amounts go higher, watch this. You think that's bad? Watch this right here. When she hits AGF modified adjusted gross income of over 133, which would be in a couple of years with more RMD requirements, now her premiums go up another $75. Her Medicare Part B or Part D goes up another $20 or so. It just gets more and more and more, and only because of RMDs. Moral of the story: if you're in your 50s and you're not proactively tax planning, you need to be doing so. You're going to have to pay taxes. There's no getting around it. But do not just look at it from a situation of income tax today versus income tax tomorrow. You got to look at it with standard deductions. You got to look at the tax brackets, and then look at it with Medicare Part B and D and all the other things that could come down the pike with changes in tax laws too. So if you're in your 50s, you really need to be doing some proactive tax planning. And we're here to help here at Heritage Wealth Planning. But certainly if you're working with a guy or a lady who does taxes or financial advisory, you better be having this discussion, because once you hit the age of 90, 88, in the 80s, there's really not much you can do about it. All right. Hope this helps. Put comments below. Thumbs up, always helpful. Don't forget to subscribe, and don't forget the notification bell to be notified when I do more content as well. Maybe we'll talk next time about how RMDs on your heirs and the taxes they have to pay as well can really be a burden as well. So again, RMDs, required minimum distributions, is not just for Jane, it's not just for Bob, but it goes downstream to heirs as well. And it can really be quite a big tax bite. All right, we'll see you next time. Thanks, guys.